All right, folks, how you doing? Ordinary Income back today. I hope you all had a great weekend watching college basketball like I did and watching college kids pretty much miss a lot of free throws. But at the end of the day, it was super exciting. Congrats to St. Francis, who is pretty much making everyone learn where they're located in the first place. Jersey City, baby. How you doing? But it was a great time. I know on Friday, during all that madness, I put out a video talking about central banks. And in that video, I talked a lot about what they do, in particular monetary policy, that they're the ones that are running it. Realizing that I probably should explain what monetary policy is too, so that's what I'm doing in this video. What is monetary policy? Well, pretty much it's just a lot of actions and tools that can be taken place by the central bank. It's what they have at their disposal to help move the economy either in a contractionary phase or an expansionary phase. So either they're going to use their tools in a way that is either helping to promote growth in the economy, promote kind of more risk taking, more expansion, or they're going to do things to scale down and kind of cool it off a little bit. You know, you might say maybe lead to a recession. I think that's a little extreme. It's more so to level off in case things get a little too wild, so to say. So within monetary policy, what can they do? With the understanding the monetary policy is simply just the central banks taking actions that they have at their disposal. That's it. What can they do? What tools they have? They have three big tools and two smaller ones. And we'll go over the three big ones first. The first one is the discount rate, reserve requirements, and open market operations. It is these first three right here. So the discount rate is pretty much what is the rate of interest that is being charged for banks like JP Morgan or Bank of America to get money from the Fed, to be loaned out from the Fed. It's how much they would be having to pay in interest if they were to ask for money to be granted from the Fed. Reserve requirements are what the Federal Reserve and central banks say banks that other banks must have, particular commercial banks, what must they have in their banks per deposit. So as I've said before, if you were to donate $1,000, reserve requirements are about like 10%, meaning for every $1,000, banks have to keep on hand 100, and the other 900 they use to give out loans or to do other things that make the banks money. And those requirements might change. Sometimes they might say, all right, we're going to go to 25% now. For every dollar, 25 cents must be kept in the bank's reserves. Or they could scale it down and be like 5%. Now for every dollar, only 5 cents have to be in there. It really is at their disposal. And then open market operations, aka stuff like quantitative easing. How is the Fed kind of partaking in markets? I guess is the best way to put it. Like right now, we know that they've been buying corporate bonds, government bonds, mortgage-backed security. That's very, that's a lot of action. That's a lot of operations that's taking place. So you kind of look to see like how frequent are they doing this? How active are they on this and all that? Now that they've been very active, it kind of shows that we're in a much more growth phase. If they scale it back and they say we're not buying mortgage-backed securities anymore, we're not buying government bonds, and we're not buying corporate bonds, that's a more neutral stance. And when they say we're selling everything that we have, that's a more contractionary stance. All right, so those are the big three. It's the discount rate, which is how much is charged on interest when banks are looking to get money from the Federal Reserve itself. The reserve requirements, and how active are the Federal Reserve with operations, particularly bond buying. What are the two smaller ones? One of them is like interest on reserves, which is something that's very infrequently done, so I don't even really want to mention. I think it's been done like 2 or 3 times in like 50 to 60 years. Very rare. The other one is the federal funds rate. And the federal funds rate, there's a lot of rates, so we're going to break it down first. Discount rate is, and this was a great thing from Quora that helped me out, but the discount rate is the interest that banks pay, like a Bank of America would pay when they borrow money from the Fed. The federal funds rate is how much Bank of America will be paying if they were to borrow money from JP Morgan. Why would they be doing that? Well, banks, all banks are holding different type of reserves. You might get, banks might have a notice that like, okay, we're going to have a client come in and they're going to withdraw $1 million. And that client might only be looking to withdraw from Bank of America. So Bank of America might be saying, all right, I need this $1 million for tomorrow so my client can withdraw. So they might ask JP Morgan, can we borrow from you and we'll pay you back later, but we just don't have it right now. And JP Morgan will say, yeah. And that will trigger the federal funds rate. How much is Bank of America going to be paying JP Morgan for borrowing money from them, as opposed to the discount rate, how much would Bank of America be paying the Federal Reserve if they were to be borrowing money from them. So that's a quick debrief. But what in particular the federal funds rate does is it is another tool. It's a more like smaller tool, I guess, not as popular as those other three that the Federal Reserve has. But but it's garnered a lot of traction. I know it's been tied to theoretically fighting off inflation. It's actually been in the news a lot because the Federal Reserve has been known to have really two big tools, and that is the federal funds rate and purchasing of corporate government bonds, so to say. So while monetary policy has three big things, and that is the discount rate, bank reserve requirements, and how much does the Federal Reserve operate in the open market, the Federal Reserve themselves really only has two, and that is the federal funds rate and how much are they buying or selling in the open market. So those are the tools that they have available to them. In monetary policy, this federal funds rate is kind of known as like a secondary tool, but in our economy, in our world, in the real world right now, the federal funds rate is a very big tool right now. It's something that is garnered a lot of attraction, especially because it's been so low for so long. And I know last week they came out of their meeting and said we are actually raising it up 0.25%, which is not a huge big deal, but it's the first step in a direction of contractionary policy. So that is monetary policy. And to review, monetary policy is just things that central banks do to either put the economy in a growth phase or a retraction phase. And they have three big tools, and that is the discount rate, how much is interest charged on banks when they're trying to borrow money from the Federal Reserve itself. The reserve requirements, how much do banks need to keep on reserve for every dollar that's deposited in their bank. And the third one is how active is the Federal Reserve in open market operations, aka purchasing those kind of government bonds, corporate bonds, mortgage-backed securities type of things. And then, of course, the secondary tools are the interest on reserves, that is something that is done very infrequently, and the federal funds rate, which is how much interest is charged when banks are trying to borrow from other banks. What does it mean to you? All these policies have an impact on you because whatever let's say the rates on banks, whenever banks have different rates on them, if it's higher or lower, that impacts how much money they have and how much profit's going to be on them. Whenever interest goes up, there's more interest expense to be paid, which means either less money to be put into investments, research and development, or really just they're trying to cut costs so they can keep profit margins. And the best way to cut costs is to cut costly labor in particular. So that's one way policies impacted. How else? Well, when the Federal Reserve, it's been shown that when they are more active in market operations, when they're purchasing more of those bonds, that it's usually had a positive impact in asset prices, in that people who own assets like stocks and real estate, the value of them go up. So we've seen a very big positive correlation that if you are an asset holder and monetary policy starts becoming much more open to growth, much more favorable to growth, then people who own assets, who own stocks and who own real estate are having bigger returns on their investments. And the problem is that if you don't own anything, if you are like a middle income or blue collar worker, you are kind of like left behind, that because these policies really impact a lot of asset owners, that you have to own assets, you have to own stocks, you have to own real estate, and if you don't, it's kind of like whatever. Now, with monetary policy, some of the tools have been linked to higher inflation, in particular in our situation right now, with the Fed being very active in market operations and keeping the federal funds rate low. We've seen a little bit of a correlation causation type of situation that inflation has been able to run pretty high. And then there's the opposite. When monetary policy is more retractive, it impacts everybody because that's when the economy is slowing down. We're seeing not as much output, not as much money is being made, profits are less, and thus jobs are being lost because corporations are trying to, and companies and the people that create jobs are trying to keep their profit margins up. They're trying to keep money flowing in, and so they're cutting labor. They're cutting expensive labor. So monetary policy does have an impact on you. Unfortunately, it's a policy that's done by not you. It's done by this group at the Federal Reserve that I'll talk about a little bit later. So it is kind of weird in that sense. But yeah, that's something to keep an eye on. The biggest things monetary policy, as I mentioned, is the federal funds rate. What are they doing with that, and how active are they in the economy? So hope you all enjoyed. This is kind of a difficult subject. I know this is covered in a lot of econ. It's usually covered within a couple of classes, so I'm trying to do it in like 10 to 15 minutes here. But if you got any questions, let me know. If I mess something up, by all means, let me know. Put a comment on the video. Follow me on Twitter. Shoot me some messages, whether they're polite or nasty. I don't care. I'll leave links to all these articles. And yeah, hope you all have a great one. And we'll be back tomorrow talking about more economic news. Enjoy, folks.